Hey everyone, this is Hard Money Jim, airing from sunny California, Coronado, California, to be exact. I hope you and all your loved ones are well so far in this very interesting year, 2025. Donald Trump and Scott Bessent have said that they want lower energy prices, and year to date, oil prices are down 12%. Check. They have said they want a lower dollar exchange rate. Year to date, the DXY index is down 5%. Check. Scott Bessent has emphasized he wants a lower rate on the 10-year Treasury bond, which would lower mortgage rates, and it makes government financing easier, among its many other important implications. Well, since the beginning of the year, the 10-year rate is down from 4.6 to 4.0. Check. Oh, and by the way, both Trump and Bessent have said that the stock market's level really isn't so important. That a 20% decline is historically normal. And of course, now we have a 20% drawdown. So check. So, by the way, that's true. A 20% decline in the market is normal. We just haven't had one in a long time since the 2022 opening of the Ukraine war, for example, when we had a 20% decline during the opening months of that war. So far, it looks to me like the Trump team is doing what they promised, and they are getting the results they expected. We may not like what they're doing, and many pundits say their actions are stupid and chaotic. But stupid or not, these people know exactly what they're doing. Now, whether these actions will result in the prosperity they promised, I cannot say. But these people do have a specific scheme, and it's our job to understand it so that we can react as investors. Now, some people are asking, why doesn't Donald Trump, a wealthy billionaire, care about crashing the stock market? Very simply, it's because most of his voters do not depend on the stock market. The people in the bottom 50% on the economic ladder own only 1% of the stocks. The top 10% own 50% of the stocks. The bottom 50% are those who don't have savings or assets. According to the Fed surveys, over 40% don't even have $1,000 saved to cover an emergencies. In the emergency, they live paycheck to paycheck, and the value of their paycheck is down 30% in real terms over the last 4 years due to inflation. So they don't care about the stock market. They do care about their jobs. They care about their income, grocery prices, taxes on the tips they make, their car payment. But these are the people who put Donald Trump in office. So, right or wrong, effective or not, this market decline is part of Trump's plan. Now, but many of you listening, and that includes me, do care about the stock market. I've made my living in the stock market for the last 40 years. So let's talk about stock valuations for a minute or two. Regular listeners will remember my January 24th podcast, in which I described at length the historically high valuations of this stock market and why I think exposure to the Standard & Poor's 500 index is not likely to work as well in the future as it has for the last 20 years or so. It's the same message I conveyed in Chapter 8 of my book, A Black Hole in Economics. I think we're transitioning into a very new kind of investment era that requires an approach that's different from what has worked over the last 20 years. I've said repeatedly that it's best to avoid the S&P 500 and especially the speculatively charged Mag 7 stocks that have accounted for most of the index's performance. Now, I'm not going to rehash all the reasons to avoid the S&P 500, except that all those reasons are still valid today, even after a 20-ish percentage point decline in some of the various market indexes. If you're shocked by the rapid recent decline in the stock market, because you shouldn't be shocked. I have to say that over 40 years of investing in stocks, one constant phenomenon I have noticed is that when stocks decline from very high valuations, the pundits and the politicians will always look to find a cause and find someone or some event to blame it on. The recent sell-off, for example, has been blamed on Trump's tariff plan, but in my view, the decline was already baked into the cake. Many things could have caused it. I mean, it could have happened due to a spike in interest rates or a hiccup in the treasury bond market in an auction, say, or an escalation in a war somewhere, or a terrorist event, or an assassination, or you name it. So I ask you, what's the real cause of this market sell-off? Is it the headline events of the day, in this case, high tariffs? Or is it the extended valuation of the market itself that just needed a reason to fall? So please look at this chart that I'm showing here. This is the Shiller cyclically adjusted price earnings ratio. Looking carefully at the decline on the far right, you can see that the PE ratio has dropped during this correction from about 37 to about 31. But even after a 20% decline in the leading stock indexes, the Shiller PE ratio is still at over 30 times versus its long-term mean reverting average of about 16 times. So if nothing else in the Shiller PE formula changed, that means we could have another 50% decline, 50% decline in the stock market just to return to the long-term average. Now, I'm not predicting that kind of a decline by any means, but this chart is significant because we have a market that has become complacent with historically very high valuations, which helps explain the sort of palpable panic now setting in among so many pundits and politicians. I would remind you of what Warren Buffett once famously said: if you cannot stomach a 50% price decline, then you have no business investing in the stock market. Now, he said that many years ago, but people forget this kind of age-old wisdom in a time of easy money and inflated markets. So do not assume the current decline is solely due to the tariff scare that's currently sweeping the world. The market was and is historically high. It was hanging by a thread. And when it is this highly valued, it doesn't take much to tip it over. Now, one factor probably weighing on the market in this particular case is the notion that tariffs might usher in a recession. The rationale on that is that tariffs by themselves are both a new tax on consumers and sort of a pinch on corporate profits, which would lead to higher unemployment, lower tax receipts, and a business slowdown. The worst case is that a recession is typically met by additional federal spending, which would involve heavy borrowing, which would then guarantee that the deficit remains high. Now, that's a legitimate concern, but I have to add anecdotally that 50% of today's consumer spending is done by the top 10% of earners. That's because stocks are so high. So viewed that way, if tariffs are a tax on consumers, that sounds like a tax the rich program to me. So maybe the left should be rejoicing about all this. Anyway, I digress. We could be headed for a recession, which we have not had in a long time. There's a theory out there that Trump and Bessent expect this, but they want to get it over with early in their administration so that they can take credit for coming out of it before the next presidential election. We'll have to see and, kind of wait and see on that. Anyway, right now, there's no strong statistical case for a recession, but there is some soft data like sentiment surveys. If you want my view on the long-term importance of recessions, you can look at my stack from August of 2022. I titled it, "Is it a recession or a banana?" Well, getting back to stocks, as you know, I'm an advocate of value investing, which I think will be the best approach to owning stocks in the foreseeable future. I recently read a good analogy by Jim Bianco, which I want to highlight and paraphrase. He said, riding the S&P 500 index has been like sailing with a 20-knot wind at your back. And all you have to do is put out the sail, look for the horizon, and go. Sailing skills don't come into it very much because you have this strong wind pushing you along from behind. And that's what years of money creation instigated by the Fed and other central banks did for stocks. specifically for the S&P 500. Nearly all U.S. stocks moved together, mostly higher, and the wind was at your back. But now there's a new sheriff in town, Donald Trump, and his deputy, Scott Bessent, who think Wall Street has been unduly rewarded, and now they think it's Main Street's turn. They've said so. The Fed can no longer wantonly, flood the world with money because the Fed has discovered inflation risk. So now the monetary tailwind has died down. And at these lower wind speeds, you need actual sailing skills to reach your destination. You have to tack and jibe and read your compass and anticipate the weather. That's the sum total of my sailing terminology, by the way. But in the same way, we now need stock picking skills or somebody who has those skills. And I believe that the sooner investors understand this, the better they're going to feel about their investment strategies. Now, as readers of my book know, when it comes to the stock market, as I said, I'm a value investing advocate with an emphasis on investing in stocks of companies with a growing dividend stream. To a dividend-oriented investor, lower stock prices are really your best friend because your dividend yield is higher. So evidently, eventually, we're going to be coming into a target-rich environment that's very good for cheap dividend-related stocks, but we're probably not quite there yet. All right. Now, for the rest of our time today, I want to focus on gold because one of the major long-term consequences of excessive unproductive money creation is an increase in the price of gold. The gold price does not move in lockstep with the increase in the quantity of money, but over a long period of time, the quantity of money is a big determinant of the gold price, especially following periods in which large amounts of money have been created unproductively and irresponsibly. So the gold price doesn't respond directly or immediately to the quantity of money, but eventually it does respond to the economic consequences of that money creation. For example, as I spelled out in Chapter 6 of Black Hole, the irresponsible money creation under the Fed's QE program pushed interest rates on Treasury bonds to near zero, which made government borrowing appear to be free, which encouraged Congress to balloon the government debt and deficits. But now the higher interest rates have returned, and the U.S. can no longer afford to repay that debt without a massive dilution of the dollar's value, which makes holding gold look pretty good as an alternative to holding the dollar. So the reason I want to highlight gold today is this. Even while the bloom on the stock market is fading, investing in gold is finally starting to come to the attention of mainstream investors in the Western world, especially in the USA. This awareness is just setting in, which tells me that even though the gold price has risen a lot recently, it is still very likely got a lot of upside over the next several years. So let us now look at gold and its recent performance, and it has been impressive. This extraordinary chart from Bianco Research illustrates the year-to-date price of gold in a historical comparison. Each little squiggly line there tracks from left to right the gold price over a specific year. The dark blue line is the return on gold so far in 2025 up to the end of March, and it's the highest percentage increase ever recorded in the first 3 months of a year. Gold is up about 16% year to date as I am speaking today, April 6th. By comparison, the top green line, it goes way up high, is the largest annual return on gold ever recorded, over 130% in one calendar year, which occurred in 1979 during a period of great inflation and budget deficit fears. The worst year was only 2 years later, 1981, when gold was down 33% for that calendar year. That's the red line on the bottom. Now, so the gold price has surged this year, reaching record new highs almost every day until the last couple of days when we've had a sell-off of about 3%. Now, part of that surge was due to a rush to get physical gold into the United States ahead of the tariff announcements, because at that time we didn't know if gold was going to be subject to tariffs or not. So there was a rush to beat the tariff. But the tariff announcement revealed that gold and probably silver would be exempt from tariffs. So as the stock market sold off, the gold price declined about 3%. And I'm guessing this is partly, but not entirely, due to the tariff story, because as people realized that gold is not going to be tariffed, the tariff price premium was eliminated and they sold a little bit off. By the way, it's worth mentioning that if you are Donald Trump or Scott Bessent, you don't want to tariff the thing that you want to be imported into the country. Now, I'll elaborate this on this point a little bit later on. But there's a better reason for the 3% sell-off in gold, in my view. In a panic, investors need cash, so they sell what they can sell, not always what they want to sell. Now, gold is always easy to sell; it's always liquid, even in a panic. So it's certainly possible that the gold sell-off, which has been minor so far, will continue as long as the panic sell-off continues. Well, so inquiring minds and nervous investors might be wondering, in light of this volatility and this sell-off in gold, should I stay invested in gold or should I get invested in gold, even though its price is right near its all-time high and the sell-off might continue? That's a good question, because when you get a big run-up in prices we have had in gold, it's normal and wise to reevaluate the value proposition, which will have implications for the amount of gold you wish to own, in what form you wish to own it, and how to position it in a diversified portfolio. So in the time remaining, I want to provide some brief comments now on how I am thinking about it. And as usual, you should evaluate my thinking as objectively as you can and make up your own mind. The last time we had a similar stock market crisis, well, a big similar stock market crisis, was in the great financial crisis of 2008, when gold fell by 30% before rising to an all-time high of $1,920 3 years later. Now, once the sell-off period passed, the appetite for acquiring gold returned, spurred by the European debt crisis at that time. The Standard & Poor's 500 went down between November 2007 and February 2009 by 50%, creating substantial losses for investors who sold their stocks indiscriminately. But as I just mentioned, gold recovered nicely and set new highs. So if we get a deep sell-off in gold on this time around, say 20% or more, I would see that as a good opportunity to consider increasing your portfolio position. Now, regular readers know that I've owned gold for many years, and I've been advocating ownership as long as I've been doing this podcast, which now dates back to May of 2021, almost 4 years ago. The gold price today is approximately $3,040 per troy ounce, as I said. So let's just go back 2 years to review my earlier podcasts about gold. Okay, on March 4th, 2023, with a price of gold at $1,908 per troy ounce, I wrote a piece called Why Everyone Should Own Gold, which advocated gold as an important part of everyone's personal savings program. On January 27th, 2024, with the gold price at 2017, I spelled out why gold is the go-to savings asset under financial repression. Financial repression being characterized by sluggish growth or negative growth and persistent inflation and government suppression of interest rates. On July 15th, 2024, right after the attempted assassination of presidential candidate Trump, I republished why everyone should own gold. The gold price at that time was $2,432. This was just kind of a just do it kind of a message. The advice was to buy gold and essentially forget you own it, but don't forget where you stored it. On September 21st, 2024, with gold at $2,518, I addressed the question, why is the gold price rising so fast? Now, if you go back and review that piece, you'll find that all the factors behind the rise in gold prices are still intact today. On January 15th, with the gold price at $2,662 per ounce, I published For Gold and Silver Owners Only, which highlighted a presentation on the role of gold in a savings program by my friend Dixon Buchanan of Monetary Metals. What we find in that one is that when you can earn interest on your gold paid in gold instead of paying storage fees, the return on gold is a real game changer. On February 10th, 2025, with gold at gold was at $2,907, I did an interview titled Hidden Money Trap, with my friend Ben Nadelstein of Monetary Metals and Company. And of course, I serve on the board of directors of Monetary Metals. We will hear more from Ben Nadelstein later on toward the end of this podcast. Okay, so that brings us up to date on the gold price. But where do we go from here? My belief is that $3,000 per troy ounce is nowhere near the top. That higher dollar prices of gold are inevitable. And that if you've not started savings and investing, a plan for saving and investing in gold, you should do so now, even though it's possible that the gold price will decline for a while. Now, why do I say this? So let's now recap some of the leading reasons why the demand for gold, and by that I mean specifically sources of demand from various investors and institutions and governments who want and need to sell their government currencies in exchange for gold. This need is intact, and I think it will continue because these demand factors are long-term and they're solid. All right. First, probably most important is point one, central banks and other monetary authorities have been buyers of gold, and they will remain buyers for some time. And they are not price sensitive. They don't care about the price. After unloading their gold holdings between about 1971 and 2000, that 30-year period, central banks started re-adding gold about 25 years ago. That was kind of post the 2001 tech meltdown. They started accelerating that buying about 10 years ago, around 2014 or 2015, which was also about the same time their official buying of U.S. Treasury bonds peaked and leveled off, despite the growing amount of outstanding U.S. debt available for them to buy. So since then, the percentage of treasuries owned by official monetary authorities, the percentage of the total treasuries outstanding owned by official monetary authorities other than the Fed, has declined steadily, and their gold buying continues unabated. Central banks are stacking their reserves with a commodity that cannot be inflated away. These central banks are not price sensitive. They've consistently bought gold even as the price rises. Therefore, I think they will likely be a reliable source of demand for gold for years to come until their gold reserves reach their desired levels. In my view, the sort of increasing mercantilism that Trump's tariff program represents, and that the rest of the world will follow on because they have to, means gold will become an important reserve asset to settle international trading accounts in an era where regional and bilateral trade agreements are going to replace the more open dollar-based trading system that we're leaving behind. Now, as the arch example of nations stockpiling gold, the data in this chart here shows what monetary authorities report to the International Monetary Fund versus what the World Gold Council estimates they are really buying. The dark bars represent estimated buying not reported to the IMF. China, of course, is the largest buyer, and it continues to buy massive quantities of gold via various entities, some official and some undisclosed. China does not appear to be price sensitive, meaning they don't think gold is too highly priced. Russia's another big buyer. Smaller holders such as Poland, India, Kyrgyzstan, and Uzbekistan have all added gold. According to the IMF figures, central banks' gold holdings have surged by roughly 200 million troy ounces. That's 6,221 tons from 2006 to 1.16 billion troy ounces, mainly driven by China and Russia. The increases in China and Russia alone represent nearly 60% of the total increase since 2006. Now, in dollar terms, these gold holdings at today's price amount to about $3.65 trillion. The IMF's chart has not been updated since the end of, has not been updated for 2024, but it shows the historic moves, and they are continuing into 2024 and 2025. Okay, point two, another demand factor, something I have not mentioned before because it's new. Chinese insurance regulators have authorized their life insurance companies to invest in gold. They're highlighting its value as a long-term store of value. If I were a buyer of life insurance, by the way, I personally would find that idea very appealing. That's just me. Now, in the meantime, traditional Indian and Chinese buyers continue to buy gold as part of their personal savings. Yeah, India and China together comprise about 37% of the world's population. Most of them love gold. Point three, as previously mentioned, gold was exempted from Trump's tariffs. Now, just think about that. You don't tariff the things you need. You do not put tariffs on what may be needed as pristine collateral in global markets and elsewhere. Given Trump's disruptive tariff moves, that might mean the gold price moves higher in the coming months and quarters, in my view at least. Given the gargantuan U.S. sovereign debt, gold eventually will have to be monetized to address that debt. It's a valuable asset, and the logic for using it to help pay down U.S. sovereign debt is just too compelling to ignore, in my view. Trump and Besant see what others see, and eventually they may use gold revalued upward in price as an asset in their newly forming sovereign wealth fund. The 8,133 metric tons of gold owned by our Treasury Department is a valuable asset. And don't forget Besant's promise to, quote, unlock the assets of the U.S. government for the American people. Okay, point four. Exchange-traded funds are now loading up on gold. They're signaling a renewed demand, I guess you'd say, from regular investors in the traditional Western investment markets. Point five, major U.S. investment banks, Citibank, Bank of America, JP Morgan Chase, Goldman Sachs, are all advocating gold, writing extensive research on gold and setting target prices ranging from $3,500 to $4,000 per troy ounce. They're also expanding their coverage on the gold mining stocks. They were not doing this a year ago. That means that gold ownership is now mainstream for institutional investors and will soon move into the retail investors' radar coverage. Point six. In addition to all this, in recent years, many states in the USA have been gradually adopting laws encouraging the ownership of gold. For example, 43 states have now removed state sales taxes on gold coins and bullion. And some states, like Utah, have said that gold certificates, like the gold back pictured on the right here, are legal tender under state law. All right, so finally, I would like to close with some words from my friend Ben Nadelstein of Monetary Metals, who interviewed me back on February 10th. Now, Ben recently recorded an enlightening analysis of gold's performance over the last 54 years. That's the period since 1971 that I call the post-gold era in my book, because that it marks the era of a complete disengagement between the banking system and gold. But notice that this last half century, that 54 years is a mere blip compared to the previous 30 centuries, during which gold was always at the center of economic activity. So there's a YouTube link to this Ben's presentation, and I wish you'd watch the whole thing. But let me quote briefly from his presentation, which is only 6 minutes long, so you should listen to the whole thing. Ben is advocating investing in gold leasing and lending with Monetary Metals and Company, which, for the sake of my normal full disclosure, I am on the board of directors of Monetary Metals. I am an equity investor in the company, and I am a customer of the company. Now, if there was any other company that provided this service, earning interest on gold, paid in gold, I would mention them. But so far, to my knowledge, Monetary Metals is unique in providing that kind of opportunity. Anyway, here's what Ben says. It's a long quote. I'm going to quote the whole. I'm going to quote a couple of paragraphs here. Unlike individual companies in the S&P 500 index, gold is a commodity, so it doesn't go bankrupt. That's why many investors have historically turned to gold as a hedge against financial turmoil and rising bankruptcies. But what about gold historically having a major drawback in that it doesn't generate income? Well, it turns out that is no longer the case. At Monetary Metals, we enable gold owners to lease or loan their gold to businesses in exchange for a return paid in ounces of gold. That means you can earn a yield on gold paid in gold, just like earning interest on cash or dividends from stocks. Now, here's the important part. Here's how adding yield changes the picture for gold. Adding just a 3% annual yield, which is below our current lease rates, boosts a $100 gold investment in 1971 to over $33,000 today, nearly closing the gap with the S&P 500, $36,000. Now, without earning interest, gold, the so-called pet rock, appreciated at an average rate of 8.19%, compared to the S&P 500 at 11.5%. But when you factor in a yield on gold, paid in gold, gold's performance improves to right near the S&P 500 level, making it a stronger competitor to the S&P 500 on return alone, not to mention its characteristics of diversity and inflation protection. Now, this is all because leasing gold gives gold owners the ability to benefit from both gold's price appreciation and ongoing income. Now, in addition to that, there is now a way to invest in the Monetary Metals program through a fund provided by a registered investment advisor. And that means that if you want to invest in Monetary Metals through an IRA, you can do so. And the link to that information is in the PDF, or you can go to the Monetary Metals website and learn about it, or get the number of a representative that you can talk to. That would be monetary-metals.com. And this program is right up my alley because I am all about having a responsible long-term savings program that will achieve financial independence. And this is an excellent way to get going in that direction for you or for your children or for your grandchildren. So in the long-term scheme of things, and in the time horizon of any serious investor, or any long-term investment horizon, it is not too late to invest in gold, despite the recent price appreciation. So go for the gold if you've not done so already. And don't forget to buy my book on Amazon, A Black Hole in Economics. If you like the book, please write a brief review, which will help spread the word through further sales. Thank you very much for listening and have a wonderful week.